After reporting earnings, DraftKings stock price exploded and is now trading at 52-week highs at $34.30 per share as of this recording. So given the move higher, can DraftKings stock move even higher from here, or is it at its limit? Well, that's what I'm going to answer in this video by reviewing the company's quarterly earnings, looking at some key metrics, and then answering if I think the stock can move even higher from here. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The big thing from the third quarter was the revenue came in so strong that management raised expectations here. Management saying, as a result of the excellent quarter, we're increasing the midpoints of our revenue and adjusted EBITDA guidance by 195 million and 100 million, the EBITDA target growth being more impressive, and they're introducing fiscal year 2024 revenue guidance in the range of 4.5 to 4.8 billion, with adjusted EBITDA in the range of 350 to 450 million. So impressive growth here from DraftKings in the quarter, and solid guidance for fiscal year 2024 had investors enthusiastic about DraftKings stock. So, as you probably already know, DraftKings operates an online sportsbook, iGaming in certain states, and a daily fantasy sports website. Now, for DraftKings, the key differentiator between itself and other gaming companies is the lack of a brick and mortar presence. And so, DraftKings' customer acquisition strategy is in spending money on promotion and incentives to attract players to its website. And this is a key metric I've been watching with DraftKings and the industry for several years now. And DraftKings in the most recent quarter saying the promotional reinvestment outperformed their expectations due to stronger than anticipated retention of existing customers, resulting in a slightly higher mix of existing customers versus new customers. Of course, if you have more existing customers compared to new customers, the performance in the quarter will be better because existing customers are not as expensive to retain, to sustain, to capture, right? They're already there, and so you're just benefiting from their activity versus a new customer, which you have to spend money to acquire, on board, get them to acclimate themselves with the platform, and eventually increase their engagement on the platform. Promotions as a percentage of GGR, which is gross gaming revenue, continue to improve on a year-over-year basis for their online sportsbook and iGaming states. And this has been a trend across the industry, is the promotional intensity has been decreasing. Other companies have started to focus more on sustainable and more profitable expansion instead of just spending money to acquire customers. One competitor actually recently exited the industry entirely. You can remember Fubo TV said, you know what, we're going to focus on our core business and we're not going to invest in expanding our online sportsbook business anymore. And so that's been the theme here. As interest rates have increased in the last year, the cost of capital has increased, and many of these unprofitable growth companies have been more focused and been more critically attuned to profitable customers, looking for the most valuable customers and not just looking for any customer just to add to the customer totals count. And that's paid off in terms of overall industry profitability and overall industry reductions in the losses on the bottom line. I mentioned earlier that on August 3rd, the company had forecasted revenue of 3.46 billion to 3.54 billion and adjusted EBITDA of negative 190 to negative 220 million. That was the previous guidance for 2023. After the earnings results, the management team updated the guidance, increasing the revenue to a midpoint of 3.67 to 3.72 billion, which is about a 200 million incremental increase in revenue, but more impressively, updating the adjusted EBITDA guidance to negative 95 to negative 115 million, which if we look at the midpoint here of a negative 105 million, was significantly better than the previous midpoint of negative 205 million. So a near 50% improvement in the adjusted EBITDA loss for DraftKings, updating for the full year 2023. So that was the more impressive upgrade in terms of the yearly outlook for DraftKings. Of course, DraftKings is still trying to gain access to more and more states for the online sportsbook and iGaming. The online sportsbook is further along in attracting new states to the platform. The iGaming side of the business not as far along in attracting new states. The company has to go state by state to gain approval to operate in the state, and recently it just gained approval to operate in Maine in 2023. So they're excited to be one of only 2 operators expected to launch in Maine later on in 2023. Of course, there are many, many more states that DraftKings can work to gain access to, one of which is the biggest prize of them all, which is California. DraftKings tried to get access to California. It had a ballot measure on the ballot box for 2022 and it failed miserably. It wasn't even close. And so that increases the uncertainty if or ever will DraftKings be able to penetrate the massive California gaming market. If it does, that could be a big boost to the company's revenue and profitability longer term. I mentioned earlier DraftKings doing a good job growing with customers and profitable customers. You could see here in the third quarter, average monthly unique players increased to 2.3 million. That was up from 1.6 million in the same quarter the prior year. Not only that, but the average revenue per monthly unique player increased by 14% to $114 from $100 in the same quarter the prior year. So not only is DraftKings adding to its total of monthly unique players, but it's also getting the higher value players, the ones that are engaging with the platform more often and spending more with DraftKings. And so that's a double dose of good news for DraftKings stock investors. So we mentioned already that DraftKings stock price is near its 52-week high or above. It's at its 52-week high, and it's now trading at a market capitalization of $15.91 billion, the highest going back in a year. But if we zoom out and we go back 3 years, that's still below the peak market capitalization this stock has traded for. It was approaching a $30 billion market cap in 2021. Now, even though it's increased significantly, it's still at a market capitalization of 15.93 billion. So given that fact, and given the fact that it's DraftKings forward price to sales ratio at 3.521, even though it's significantly higher from the lows, it's still down from the peak valuation of over 15 price to sales forward around 2021. Now, there were some unique characteristics, some unique factors causing the price to be so high in 2021. Remember, that's when brick and mortar casinos had to shut their doors and customers had no choice. If they wanted to gamble, if they wanted to bet on sports, they had to go with online sportsbook because physical casinos were closed. And so that fact, as well as other factors, were helping DraftKings gain customers at a faster than normal rate. That's not expected to happen anymore or at any time in the future. However, that being said, DraftKings has an advantage in that it doesn't have to operate a brick and mortar casino. So if you think about it, 2 companies generating a similar amount of revenue, you can think of the brick and mortar casino and DraftKings, each of them operating the same amount of revenue. DraftKings should be more profitable than the brick and mortar casino because it doesn't have to pay all that money to operate that physical presence. It doesn't need the building, the maintenance, the staff, and all of that that goes along with operating a brick and mortar casino. So longer term, the profitability prospects are better for DraftKings compared to a brick and mortar casino. So that being said, Yeah, I think there's room for DraftKings stock to move higher, although I don't know if that's going to happen right now. I don't know if the stock needs to capitulate a little bit to, you know, establish this new valuation, or if it could continue carrying the momentum higher from here. But longer term, I think the company's business model and foundationally, it's inherently more profitable longer term versus a brick and mortar casino if it can reach a similar scale. That's the big question. So, right? But before I let you go, if you've gained value from this video, which you probably have if you've made it this far, I would really appreciate it if you would subscribe to the channel. It would really help me create more videos just like this one. Thank you for watching.